On today's hot sheet, I'm discussing residential vacancies and homeownership stats, plus the latest on mortgage applications, job openings, and private payroll data. Today is Wednesday, January 31st, 2024. I am Byron Lazine, and the hot sheet starts now. Huge day here as we close out January. I'm up in my Connecticut studio. Let me know in the live chat where you are tuning in live from. Why is it a huge day? Well, it's a Jerome Powell day. The FOMC is going to finish off their 2-day meeting, and Jerome Powell will take the stand. Now he'll conduct his press conference as he does after every FOMC meeting. He'll be doing that later today. So tomorrow morning, as we always do, the day after an FOMC announcement on whether they're going to hold the national interest rate, whether they're going to raise, whether they're going to decrease. The market hasn't priced in as doing nothing. We will break down the entire press conference. It's more about what he says. It's more about what the committee indicates is going to happen in the future that the market is going to react off of. We go through that 50 or hour-minute press conference each and every single meeting, and we pick it apart here on the hot sheet. Tomorrow, we're going to have all of the timestamps that Jerome Powell mentions housing. We're going to have a really detailed breakdown of that. So make sure you subscribe to this channel so that you do not miss that. You also don't want to miss today at 2 p.m. the interview, the exclusive interview I conducted with Ryan Serhant. I don't talk, by the way, in this interview, he's like, nobody asked me these questions. Everybody asked me about social media and branding. I don't talk about those things. I talk about the business tactics that real estate agents need to move their business forward. That's getting released today at 2 o'clock right here on the channel. So make sure that you subscribe and hit the thumbs up on this video if you're enjoying what we're doing at BAM. Of course, to get the most out of BAM, you need to be in BAMX. Use code HOT to get 10% off of that. All right, let's jump into it. Home ownership statistics as just released by the U.S. Census Bureau. Okay, these are home ownership statistics for quarter 4 in 2023. These were just released yesterday. National vacancy rates in the fourth quarter were 6.6% for rental housing and 0.9% for homeowner housing. That 6.6% for rental housing is up. That's a number that's trickling up as of late as rent appreciation continues to come down. And even year over year, overall rent prices were down. Everybody besides Zillow believes that, and maybe Jerome Powell. The rental vacancy rate was higher than in the fourth quarter of 2022, which was 5.8%, and virtually the same as the third quarter. So third quarter, fourth quarter flat at the 6.6% for rentals. The homeowner vacancy rate. So, just a home that's not being rented, but is vacant, of 0.9% was not statistically different in the fourth quarter of this year than it was in 22, and not statistically different than the rate in the third quarter. Really, those came in at 0.8%. Now we're at 0.9%. So pretty much flat on vacant homeowners. That might be somebody who's left a property, maybe they're just not using anymore, but they're not willing to sell it. It could also be somebody that's in pre-foreclosure. I know just downstairs, one of our ISAs said, hey, just got to call these people, their neighbors. The property says foreclosed on Zillow, but it's not on any auction sites. We know what that means. It means the banks maybe foreclose on it. They just haven't done anything with it yet. And so why it's important to educate consumers, because for the consumer to understand, okay, well, this is a foreclosed property, thinking deal. No, there's no deals on these foreclosures that are actually coming to market right now. They're coming out at market value because of the inventory issues that we're experiencing. The rental vacancy rate was highest in the South at 8.7%, followed by the Midwest at 6.8%, the West 5.1%, and the Northeast at 4.3%. Northeast being having the region with the least inventory. So it makes sense there. The homeowner vacancy rate was the highest in the South, 1%, followed by the West at 0.8%, the Midwest at 0.8%, and the Northeast at 0.8%. Homeownership rate was highest, okay, in the Midwest. 69.8% of folks in the Midwest, almost 70% are homeowners. 70% homeownership rate in the Midwest. They believe in home ownership there. I love it. And it's more affordable there. So hats off to the Midwest on the home ownership rate being at basically 70%. The South is at 67.8% home ownership rate. And then you've got the Northeast and the West, where homes are much more expensive, generally speaking, than the other two regions. So this, relates to the affordability issue. If you're living in the Northeast region or the West region, you only have 61.5% home ownership rate in the Northeast, followed by 61.4% in the West. So when you get into some more of these unaffordable markets, naturally home ownership is dropping. The home ownership rate overall for the country was 65.7% in the fourth quarter of 2023. So both the Midwest and the South are beating the national home ownership rate. Midwest, best prices of any of the four regions, best opportunity for affordability of any of the four regions. And then South, think the Sun Belt states, think a lot of retirees. Most retirees, when they move, when they're making that first move, I particularly know a lot about the Florida market. They don't want to rent. Okay. There's not, when you think of some of these retirement communities, there's rental opportunities. It's usually seasonal. Okay. But for those that are relocating year round, you don't see a lot of retirees that want to just go down there and rent. Okay. Maybe in the beginning, but they ultimately do want to buy. Okay. In approximately housing inventory, approximately 90%, 89.9% of housing units in the United States in the fourth quarter were occupied, with owner-occupied units making up 59.1% and renter-occupied units making up 30.8% of the inventory. So, shout out to PropStream. Let's put our link for PropStream in the comments. It's usually in the description. We've got a great deal going with PropStream and BAM. We're using PropStream downstairs in our ISA department. But PropStream is a data resource that agents can use or investors can use to target that 10%, 10.1% of homes that are unoccupied. If 90% are occupied, 1 out of 10 are unoccupied. We want to loosen up this lock-in on inventory. Those are homes to target. Okay. Vacant year-round units comprise of 7.7% of total housing, while 2.5 were vacant for seasonal use, 2.5%. I would actually have thought that number might have been a little bit higher, with how many folks do the couple home thing, but 2.5% vacant for seasonal use. Approximately 2.2% of the total units were vacant for rent, 0.5% were vacant for sale only, and 0.5% were rented or sold, but not yet occupied. All right. We've got a detailed show notes today for you. Of course, we drop that into BAMX for everybody, as well as all of the charts be available for BAMX members to grab easily. And here's a look here from rental vacancy rate. Obviously lower than, the recession of the great financial crisis, but higher than we've seen in the last couple of years. So starting to move up. Still 6.6% is not a worrisome number on rental vacancy, but I do expect that number to continue to increase as more inventory continues to hit the rental market, as we've built the most multifamily in history over the last couple of years. Here's the rental vacancy by region. South, where you've gotten a lot of investors looking to, buy properties for purpose of rent. You even have a lot of communities that are being built primarily for renting. You see that the vacancy rate there is one of probably getting into concerning mode. The South is at 8.7% in the fourth quarter of 2023 for rental vacancy. The Northeast is really leading the pack on a healthy vacancy rate that at 4.3, the West at 5.1. And that also, it's the opposite of that home ownership stat, right? Home ownership stat is the lowest in the Northeast, lowest in the West, but vacancy rates there are the lowest. Why? Because home ownership has become so unaffordable in those regions compared to the Midwest and the South, that more people are likely to turn to renting, and then that creates less rental inventory. Okay, the United States is again at 6.6% on rental vacancy, and compared to 5.8 in the fourth quarter of 22. And here are the home ownership rates. You can see here that they're mostly unchanged from 22, but they're all down except for the South. Okay, everybody's down nationally. The Northeast, the Midwest, even down from 70.1 to 69.8. Still an incredible home ownership rate there in the Midwest, and also down in the West. But the South is up 66.7 to 67.8 year over year, looking at the two fourth quarters. Okay, so there's an update on home ownership and vacancy rates. How can you use this to your advantage if you're an agent or an investor? I'd focus in on those vacancy rates. Where are the 10% of homes in your market that are vacant, and having a plan to reach out, probably both via phone call and text message, as well as through the mail, to get to those homeowners and see if there's an opportunity to help serve them, to unlock that inventory in your market, and also to get them their equity here at peak pricing. Marissa has a question: is rental vacancy on apartments or on single family homes? In which case is it a good time for investors? I think it's a well, I'll answer the second question first. I think it's a you should be very cautious as an investor. Okay. I don't think that investing in this landscape right here with where the rates are is a slam dunk. I mean, I know every single day when I go on YouTube Shorts or on Instagram or whatever, I see somebody talking about, oh, go buy real estate and then wait 6 months and refinance it and roll that money in. And yeah, I love the plan. I love the deal of refinancing property, tax-free event. But are you going to be able to refinance that property for more? Are you really getting a spread on your cash flow in these low inventory markets with vacancy rates on the rise, not going down? Are you going to be able to really, you know, get whatever rent you want, or are you going to have to throw in, a free month's rent or some other incentive right now? I think it's a hard game for investors to get cash flow right now. The other question was this U.S. Census Bureau data on single family homes, or was it on apartments? This is, I believe, on single family residences. Let's just double check that. And I'll just go right from census.gov. Homeowner housing. Yeah. So the homeowner housing would probably include condos, or, it might include 2 and 3 family units, but it certainly wouldn't include apartment buildings on this particular analysis. Okay. We know that apartment buildings overall vacancy rate are also on the rise. We've been covering that here on the hot sheet month over month. Mortgage applications, something that we're really concerned about. And this week's number is ultra concerning to me. Okay. We now have a full month of data. It is January 31st. We're closing out January. And we talked about, as the rates started to drop in December, as we got that Santa gift of momentum going into the end of the year, where rates just really cooled off and the 10-year really, took something off of the top there. I said, if this continues throughout January, we could have a light switch effect in January. We could have a kind of a market that really takes off and is running. Well, now 31 days, we've closing out January today. That hasn't happened. And this latest mortgage application data doubles down on that point in probably the biggest exclamation point of all of January. The seasonally adjusted purchase index here, according to Mortgage Banker Association in the last week, decreased 11% from 1 week earlier. This is a time of the year that we've been talking about, hoping for an increase in mortgage applications, an increase in buyer demand as we start to get into the beginning of the best season in residential housing, the spring market, as we're entering the first and second inning of the spring market. We want to see mortgage demand, interest, consumer sentiment, applications in mortgage on the upswing heading into the spring. Now, last week here of January, or really the week of ending January 26th, we have an 11% decline. We've been seeing we saw 8 weeks of week over week increases. Okay. And then now all of a sudden, this significant drop tells us that there's more bumps in the road than maybe we were hoping for. I've been saying that, when, especially as it relates to the 30-year fix, everybody running around saying we're going to be in the fives, not so fast. Okay. The first 31 days of the year have taught us that. I'm not going to necessarily be in the fives in the mortgage 30-year fix at any point this year. I'm rooting for it. I'm hoping for it. Love to see it. I mean, with Senator Warren's letter yesterday, I think this is an indication, more so than ever, that, yeah, I'm in her camp, Jerome. Let's get this rate down sooner than later. Inflation has shown that it is trending down, and we need to get these rates down to help not only the home buyer, but to help this entire industry kind of get out of the mud. But, for every agent that says they're busy right now, what does your MLS say? Does your MLS say January's experienced more deals or less deals? Love to know in the comments. Is this January better or worse than last January right now? Not for your personal business or your feeling. Okay. Love feelings. Love feelings here on the last day of January. But what's your business actually look like in your MLS? Okay. Because last year on this day, we had I'll just go to the chart here on Mortgage News Daily. Last year on this day, we had a 30-year fixed rate of 6.17%. Yesterday, we closed out at 6.87%. So if you remember last year during this time frame, we were on the downslope in January, and then February the 2nd, we actually touched the fives, 5.99. January did feel last year like there was a little bit of a light switch. November and December of 22 were so slow. They were so bad that anything could feel like a light switch. But this January, based on applications, what we're seeing in regional markets, could certainly be worse for many agents than even last January, which is one of those red flags about the future of 24. We keep looking to say, the bottom is behind us, and nationally, new listings are up. Nationally, inventory is up. If you're in the Northeast, you're like, well, not here, it isn't. But nationally, those two numbers are up. We're hopefully closer to the federal interest rate coming down. We'll find out more, obviously, this afternoon and cover that today. So there are indications that the bottom could be behind us, but regionally, a lot of people are struggling. I talked to agents down in South Florida. They're like, it's been dead for 3 months. January is usually that seasonality uptick. Everybody's coming down there. People want to buy properties. It hasn't been the same, the same as it's been in recent memory. Okay, obviously not in recent memory. All right, here's the quote from Mortgage News Daily, from Mortgage Banker Association. Mortgage rates changed little. So rates didn't change that much with this big drop. It's close to where it's been, basically 6 3/4 on the high side of that, certainly in the last couple of weeks. Obviously lower, percent lower than where we peaked in October, but applications decreased compared to a holiday adjusted week. The week prior was a holiday adjusted week with MLK Day. being that Monday prior, driven by a decline in purchase applications that offset a slight increase in refinance activity. So refinances were actually up last week, a couple of points. Refinance index increased 2% from the previous week and 3% higher than the same week 1 year ago. So refinances were actually up a little bit, but overall, because applications, new mortgage applications, new buyers entering the market was so down, 11% down from the previous week. And by the way, 20% lower than the same week a year ago. And this is my point, that while inventory's up, new listings are up nationally, great signals. We got to start seeing demand now move in a positive direction, because demand being 20% lower than it was a year ago, it's one thing last January, and we're like, demand's down 20% from a year ago. Of course it is, because in the beginning of 22, we had interest rates at 3-4% in the first quarter of 22. But now, when we're comparing 6.75% to 6.25%, which is where we basically were at this point last year, and demand is down 20% on a half a point, that's where, we believe we've got a lot of pent up demand. We've got a locked up, inventory situation, but we need to start seeing it in the data, that pent up demand is coming out of the woodwork and entering the market. It's not happening right now, according to this Mortgage Banker Association data. Low existing housing supply is limiting options for prospective buyers and keeping home price growth elevated, resulting in a 1-2 punch that continues to constrain home purchase activity. The average loan size for purchase application has picked up in recent weeks as well to $441,100. The largest average loan size since May 2022, speaks to people stretching there because of the the unaffordable climate that we're in, with the low inventory and prices being at all-time peak levels in most scenarios. Refinance activity increased to 34.4 or 34.2% of total applications. Think about that. Total mortgage applications, over a third of them were refinanced when they're refinanced when everybody thinks that rates are high. So that also gives me an indication of the homeowner might not have as much money as we believe that they do. Why are a third of mortgage applications refinance when most of these folks are locked in under 6%? You want to refinance over 6%? That obviously means you need the money for something. So signals to watch there. My point is, the urgency for real estate agents, for investors that are trying to find a deal, has got to go up. You got to take this market as, if you watch football, and I know we're coming up on the Super Bowl. If you remember that Patriots, not a Patriots fan, by the way, I'm a Giants fan. Watch that Patriots Falcons Super Bowl, 28-3 at halftime, and then the Patriots come back and they win that game. They had a different sense of urgency in the second half. They were in a no huddle offense. They weren't huddling up, taking their time. Real estate agents and investors can't take their time in this market. You have to be on the attack at all times. It means more outbound. It means, you can't walk through your day like you were in the beginning of 22 and expect things to happen, expect touchdowns to score themselves. You got to push the ball forward and move it into the end zone and take a more aggressive attack approach in this market, because waiting for interest rates to come into the fives, we're looking at the data every single day here on the hot sheet, is a bad formula for success. All right. Something else that the FOMC, I'm sure, is talking about yesterday and today, we'll find out later today, maybe even the topic of discussion, is what's going on in the job market. Okay. Job openings and labor turnover. The number of job openings changed little at 9 million on the last business day of December. This is according to U.S. Bureau of Labor Statistics. Over the month, the number of hires and total separations were little change at 5.6 and 5.4 million, respectively. So there you go on job openings. Basically, job openings, down. Okay, so down from where we were, the peak at 11 million, or really the high was 12 million in March 22. Excuse me. That's a good sign that it's cooled, but we still have a significant amount of job openings, which would be a leading indicator that we're probably not going to see much of a change here on unemployment. We certainly haven't seen that as of late. Unemployment going up a little bit is something that could help, the Fed in their case to start cutting sooner, because they want to see, less of a chance of inflation taking back off. Going to private payroll, which also was released. The ADP National Employment Report indicates a growth of 107,000 jobs in the private sector for January, showcasing positive momentum. It's a 5.2% increase in annual pay. Has also been reported across the board. Progress on inflation has brightened the economic picture despite a slowdown in hiring and pay. Wages adjusted for inflation have improved over the last 6 months, and the economy looks like it's headed towards a soft landing in the U.S. and globally. That's the chief economist for ADP said following this release. So job market continues to be strong as we head into a press conference later today from Jerome Powell, which we'll all be tuned in for. And you know what? With all of hey, real estate housing has a bumpy road ahead. I've got some good news to finish off the day for you. Look at this 10-year now down below 4%, the lowest we've seen in, I don't know, let's find out how long it's been. It feels like it's been a month, but it hasn't been that long. Lowest that we've seen since January the 12th. Yeah, the lowest we've seen since January the 12th on the 10-year Treasury note, as the market anticipates Jerome Powell's press conference coming out of the FOMC meeting later today. We break that whole thing down here tomorrow on the hot sheet. And I just want to stare at this 10-year here, 3.942, because it means that later on today, we should have a 30-year fix that maybe gets back down to 6.75 on the Mortgage News Daily Read. We ended the day at 6.87. There could only be good news ahead on the 30-year fix with where the 10-year is. And maybe we even get a weekly survey that comes back down to 6.6 or so. I don't know. Market is, 10 years dropping. Maybe the market believes there's going to be a strong indication of the next cut. So the next meeting would be, they're always about 45 days out. So the next meeting would be, say, middle of March. So could we get a Q1 drop on the federal target interest rate in the middle of March? Nobody expects that to happen today. It'd be a shocker if he comes out and says we are cutting today. Obviously, we would embrace that. I'd expect if that were to happen, you'd see the market really move, both stock market and the interest rates move in a very positive direction. If he were to come out and say that it's not expected, it's not priced in, but maybe the market right here is moving based off of an expectation that he's going to come out and say we've made a decision, or they wouldn't say they've made a decision. They're going to be very careful with what they say, that indications are pointing towards an earlier, maybe Q1 March meeting, decrease on the rate. The market is not really doing anything. Dow, S&P, Nasdaq, is doing something down over a full percent, almost 200 points. Dow's not doing much, pretty flat there. S&P down a half a point or more there as we await the Jerome Powell talk today. Between now and tomorrow morning, when I break down what the FOMC decision is doing, you can tune in at 2 p.m. to this channel for the exclusive release of the Ryan Serhant one-on-one interview that I conducted. You do not want to miss this. Subscribe to the channel so you don't miss it. This is probably a Q1 cannot miss interview in housing. I asked Ryan questions that he is rarely asked about. And if you're a real estate agent specifically who wants to advance your business, you got to check that one out. All right. That's it for today. We'll see you back here tomorrow on the hot sheet when we break down the decision from the Fed. Until then, toodaloo.